Assalamu alaikum, everyone. Welcome. It's great to have you here. For today's webinar, we're going to be diving into the topic of tax planning. Inshallah, we plan to demonstrate the value of going beyond focusing solely on tax filing by taking a more strategic long-term approach to taxes through proactive tax planning. Inshallah, a timely topic with tax day right behind us. What's probably top of mind for everyone, as it always is this time of year, is my God, I just pay way too much in taxes. And I hear you, brothers and sisters, you're not alone. So today, inshallah, we're going to be showing you how financial decisions that you make throughout the year may potentially reduce that tax burden for next year and over your lifetime, inshallah. A quick housekeeping note before we dive in: this webinar is being recorded and all registrants are going to receive a copy afterwards. And just a reminder, the information that we'll share today is educational in nature and not intended to be personalized tax advice. So be sure to speak with your tax advisor before implementing any of the strategies that we will be discussing today. So before we dive in, let me briefly introduce ourselves and the agenda for today. I'm Tamim Qasim, Associate Financial Advisor here at Izad. I'm going to be covering what tax planning is, why it matters, and what it typically entails from a high level. I'm also joined by Reem Hussein, our Chief Planning Officer, who's going to be joining us in just a bit to bring us up to date with the latest tax code changes, as well as strategic tax planning opportunities for 2026. And then, inshallah, we'll discuss specific tax planning considerations across 4 common client household profiles, so you can see how we approach tax strategy across each financial stage of life. Lastly, we're going to take some time to answer some frequently asked questions as well, inshallah. Real quick, for those who may need a quick refresher, here's a little bit of information about us. For nearly 30 years, Izad has helped high net worth Muslim investors grow and preserve their wealth in accordance with Islamic principles. Today, alhamdulillah, we manage approximately 1.8 billion for just over 1,000 households and organizations across the United States. What really sets Izad apart is the nature and the quality of our service. It's truly curated to the unique faith-based values of the Muslim community with the same level of sophistication that you'd expect from any leading conventional brand name firm. Our clients get to work with a dedicated financial professional, and they gain access to a full suite of comprehensive planning services, not only including today's favorite, tax planning, but investment, financial, charitable, retirement, and estate planning as well, all delivered in accordance with Islamic principles. So with that, let's get started. As the saying goes, there are 2 things in life that are certain: death and taxes. And if I had to pick between the 2, I think I'd rather just pay taxes. But that being said, taxes, they touch every part of your financial life, and your tax return is almost like a financial fingerprint. It's unique to you, with clues about your sources of income, deductions, and credits. And us as financial planners, by sifting through these details, we can help you unlock opportunities for smarter tax planning. So what makes these opportunities so important? When we talk about tax planning, it helps to start with the bigger picture, why we as financial planners place so much emphasis on it in the first place. This can surprise people, but achieving strong financial outcomes actually goes well beyond investment performance alone. While we do our best to pick investments favorably, we really can't control the market conditions that impact the market overall. So rather than focusing on factors that are outside of our control by trying to time the market through short-term trading, we want to make intentional decisions within our control, and those are decisions that can really help drive positive long-term financial outcomes. Of the decisions that are within our control, tax strategy is, in my opinion, one of the most impactful, because the decisions that you make can really directly impact how much of those returns you actually get to keep after taxes. Two investors could achieve the same returns, but tax strategy can actually differentiate their outcomes significantly, especially when that compounds over time. Furthermore, not just with returns, but tax inefficiencies in how you realize your income, transfer your wealth to loved ones, or give to charity can cause excessive tax burden, which can add up significantly over time. So the goal of tax planning is to avoid that, inshallah. A common question that we receive when we talk about tax planning for the first time with prospective clients is, how does this really differ from what my tax preparer does for me when they file at the end of the year? Now, tax planning and tax filing, while they both deal with taxes, are two different things. Tax filing is the process of preparing and filing your tax return. Tax filing is all about compliance. It's about making sure that you've calculated your income and deductions correctly and that you're paying what you owe to the IRS. On the other hand, tax planning is a forward-thinking strategy. It's about making smart decisions today and year-round to reduce future tax burdens. So let's break down these two concepts a little further, just so you can see why, when it comes to future financial success, tax planning is far more impactful. So at its core, tax filing is the process of organizing and documenting your financial history for the year. What you're doing is you're reporting on what already happened, but you're not necessarily changing the outcome. So the tax preparer's role here is to gather all of your documents, your W-2s, 1099s, and make sure that income is accurately reported and that deductions, refunds, and tax rates are correctly applied. So their job is to ensure compliance based on past events, past taxable events, not necessarily planning around future tax events. So for example, a tax preparer is going to help you report your charitable donations, right? So you can get your deduction when you itemize, but they're not going to advise as to how much and when you should donate, what charitable vehicles would best serve your tax strategy, or whether you should fund that donation with appreciated stocks versus cash next year. Now, some tax preparers, they may toss in a quick tip, like contribute more to your 401k next year. But overall, the focus is really on past events and how they're captured. There's not really a lot of forward-thinking advice baked into the process. So now, while tax filing looks backward, tax planning looks forward. It's about proactively charting a course to reduce your taxes, not just this year, but over your entire lifetime. So this is really where we dig into your tax return and your broader financial situation, not just to report on what happened, but what we're looking for. We want to find opportunities. And those opportunities are found in any decision point that could impact your taxes. So maybe it's timing your income, shifting deductions, or utilizing tax privileged vehicles, which we'll talk about a little bit more in a bit, or perhaps taking certain actions to qualify for tax credits or deductions in the future. So unlike tax preparation, which is about staying compliant, paying the right amount, and capturing deductions and credits from tax events which already took place, tax planning is about staying strategic. It's the difference between reacting to and intentionally planning your future tax events. So one thing that we want to clear up right away, this is a common misconception, is that tax planning is not just about getting the biggest refund. A large refund might feel good in the moment, but it doesn't necessarily mean that you've done the best tax planning or that you have the best tax strategy. In fact, a large refund could actually suggest that you've just overpaid throughout the year. So the goal of tax planning is to minimize your overall lifetime tax payments, not just focus on 1 year's refund. And by planning, the hope is that you can keep more of your money over time. So this goes far beyond what tax preparation services typically deliver. If you're looking for tax planning, generally professionals like CPAs and tax planning focused CFPs with specialized knowledge are typically the ones that can actually help you with tax planning. And often, tax planning isn't a solo effort. It typically involves collaboration, multiple professionals working together to design a strategy that makes most sense for your unique financial situation. Different professionals have different angles and perspectives on your financial circumstance. Here at Azad, we coordinate regularly with our clients' accountants to be sure that the strategies are suited to their tax profile and that things are being reported correctly. So at Azad, we typically meet with clients for tax planning on an annual basis, sometimes slightly less, depending on the complexity and moving parts in their tax situation. Here's a look at Azad's tax planning process. So we generally begin the process by wanting to gather all of the information and get an idea of, okay, what happened this year and what's going on in your financial life. So we're going to gather all of your relevant documents, that's tax returns, investment cost basis details, and then as well as any qualitative updates, like what's going on in life. Are you planning to move? Have you had changes in income? Any changes in goals? And other personal circumstances like these. So next, in the second stage, we want to identify what are the key decision points that we can make that will result in a positive uh, impact on your overall lifetime tax burden. And then what we do is we model the potential tax impact of those decisions using tax planning software. So with scenario analysis, we can compare these different strategies and get an estimated amount of how they impact your tax burden this year and the next few years as well. And so based off of that, that informs our decision on what would be the most optimal tax strategy for you. Finally, we would review the findings together with you and implement, agree upon, make sure that it works with you, and then we would implement that recommended tax strategy. So this ensures decisions are both tax efficient and aligned with your broader financial plan. So this slide highlights several key levers or decision points, as I like to call them, that we can use to improve tax efficiency across a client's financial plan. Now, these really depend on your personal situation, but these are some of the tools that are at our disposal when it comes to tax strategy. So starting with timing decisions. So this is about being intentional with when income and deductions occur. Not all income timing can be controlled, but the ones that we can control, we want to be strategic about when we realize them. So income from sources like K1 distributions, RSUs, stock options, or capital gains can often be timed and spread out to avoid pushing yourself into a higher tax brackets. On the flip side, we can time deductions, make sure that we are taking them in the years where they're most valuable. Perhaps it's a higher tax year. And so deductions can be timed as well. Another one is taking advantage of tax advantaged vehicles. This is one we'll get into more. Reem is going to get into more in just a bit. But here, really, the focus is on maximizing the use of tax advantaged or tax privileged accounts wherever it's appropriate. So that means fully utilizing qualified retirement plans, IRAs, custodial and education savings account for dependent goals. By prioritizing these vehicles and by prioritizing these vehicles where they are aligned with your goals, it can really help you reduce current taxes, defer future taxes, or even in some cases where you're using a Roth, eliminate taxes on growth entirely. Another one we have is tax loss and gain harvesting. So this is a proactive, ongoing strategy where you're taking a look at the positions within your investment accounts and you're realizing losses to offset gains in high income years, or perhaps realizing gains in lower income years to take advantage of more favorable tax rates. Over time, this one can actually have a meaningful impact on the tax liabilities you build up through appreciation. So it's a really great strategy, and we implement it on an ongoing basis for a lot of our clients here at Azad. Withdrawal sequencing is another important consideration, especially when you get close to retirement or into retirement. This is, when you start drawing from your portfolios, the order in which you tap into taxable, tax deferred, or tax free accounts can significantly impact how long those assets last and how much you pay in taxes, because each of these are subject to different tax rates. So there is an optimized combination and it's specific to each person. So that's one area where we can be strategic with the decision making. Another one is filing status, deciding whether you should take a standard deduction versus itemized deduction, whether to file jointly, separately, or head of household. These can materially affect tax outcomes, especially in more complex situations. And then another one is charitable giving strategies. This is big. Alhamdulillah, our community is very charitable. So using vehicles like charitable trusts or donor advised funds allows people to support the causes they care about while also improving tax efficiency through certain strategies like bunching deductions into a single year. That's one that is very common for a lot of the people we work with. And finally, Roth conversions, which deserve some special attention. So this is where you choose to pay taxes now on pre-tax IRA balances, ideally at a lower rate than you would expect in the future, so that you can allow it to grow tax-free for the future. So taken together, these strategies are all about being proactive so that taxes don't just happen to you, but are managed strategically in coordination with your overall financial plan. And so this is, a big point we want to emphasize is that when it comes to high earners and business owners who have more complex situations, they often need more than just general basic tax advice. Their financial lives are much more complex, and so are their tax challenges. And that's why surface level strategies typically aren't enough. And there's two main reasons why. First, often these folks, if you're one of them, this might resonate with you. You're dealing with many multiple types of income. So rather than just a simple salary, income may be coming from business activity, K-1 distributions, RSUs, employer stock options, and more. So each of these income sources are taxed differently and often at different times, which creates the need for careful coordination around timing, character of the income, and cash flow. Second, the tax code really becomes far less forgiving at higher income levels. Marginal tax rates can reach as high as 37% before you even factor in state and local taxes. And at the same time, many of the deductions and credits that they begin to phase out or disappear altogether at this income level, while additional taxes and surcharges like net investment income tax and whatnot may apply. So as a result, planning for these folks becomes a lot more nuanced. You can't really rely on just simple rules of thumbs. Instead, strategies really need to be modeled and tailored to the specific details of each situation to determine the most effective path forward. And that's really where working with a dedicated financial advisor becomes very valuable for these folks, because you're dealing with a single person over time who's staying up to date with all of the moving parts in your financial life. With an ongoing relationship, you get more personalized guidance from someone who has the full context and not just isolated pieces. And so with that, I'm going to turn things over to Reem, who's going to go ahead and walk us through some of the key changes in the tax code, as well as opportunities they might bring for this year, 2026. Go ahead, Reem, if you want to take it from here.
Yeah, thank you, Tamim. So for this part of the presentation, we are going to look at recent tax law changes. So not just what they are, but how they influence tax planning decisions. So as you know, last year, Congress passed a major tax bill known as the Big Beautiful Bill. So this legislation includes broad changes that can affect income taxes, retirement planning, and overall financial strategies. So this is not just a compliance update, it creates new planning opportunities. So the bill has passed. So what I would like to do now is walk through some of the key provisions that may affect planning. So in this section, I have grouped these into three categories: provision made permanent, updated provisions, and the newer provisions introduced under the law. So we will touch on areas like tax bracket and standard deductions, update to the state and local taxes, and the child tax credit and the charitable deductions rule. And also we will cover newer provisions, including the enhanced senior deduction, charitable deduction for non-itemizers, and the new investment account for dependent. So as we go through these, the key thing we want to keep in mind is that these are not just technical changes in the tax law. Many of them may create planning opportunities worth revisiting. So let's start with the provision that were made permanent under the law. So this is important because many cases, these were provisions that had been scheduled to sunset or were subject to uncertainty. So making them, I would say making them permanent, the law creates more stability for planning. So this can be helpful when making longer term decisions around income, deductions, savings, and retirement strategies. So one of the foundational provisions made permanent is the current ordinary income tax bracket structure. The 10, 12, 22, 24, 32, 35, and 37 brackets remain in place, which provide some, again, like continuity for planning. And that's matter because, again, because it's give more stability when thinking about decision tied to income and whether, for example, strategies like Roth conversion or withdrawal strategy or managing taxable income over time. So as you see here, like the 2026 tax brackets reflect slightly increase in the income threshold compared to 2025. And this is mainly due to the inflation adjustment. Again, would say like the changes may seem small, they can still play a role in tax planning, and particularly when we come to timing income and managing which bracket you fall into. Another provision made permanent is the standard deduction. So the standard deduction is simply fixed amount that you may subtract from your income before calculating federal income tax. So many households continue to use it unless the itemized deductions, things like mortgage interest, charitable giving, state and local tax deductions, or large medical expenses exceed that amount. So for 2026, the standard deduction increases to $32,200 for married filing jointly, $16,100 for single filers, and $24,150 for head of households. Moving to the state taxes. So for 2026, the state tax exemption increases to $15 million, creating more flexibility for transferring wealth without triggering federal estate taxes. In addition to that, the annual gift exclusion rises to $19,000 per person, which provide ongoing opportunities for tax-efficient wealth transfer each year. So even with today's high exemption, state planning is still important. I like to remind clients that it's not just about reducing taxes, it's just making sure your wishes are clear, keeping control over how things are handled, and passing on your values along with your assets. So if your state is under like the $15 million, you probably don't need to worry about the federal state taxes, but if you are over that amount, or if you own a real estate or business, it's worth looking at strategy like lifetime gifting, setting up a trust, or making charitable gifts. So the exemption, again, is helpful, but it does not replace the peace of mind that comes with having a solid plan in place. Moving to updated provisions, let's touch on one of the important change under the new tax law, the expansion of the state and local tax deduction. So in the past, many taxpayers have been taking the standard deduction, and part of that because in 2017, tax law doubled the standard deduction and capped the state and local tax deductions at just $10,000. So that made the itemized deduction or itemizing less beneficial for many households. So under the new tax law, the state and local tax cap increases to $14,000 beginning in 2025, with small inflation adjustments after that from 2026 to 2029. So for many households, particularly in the higher tax states, this may make like itemizing worth revisiting because of that increase in the the deduction. It's also may create a new planning opportunity, especially when coordinating with charitable giving or other deductions. But again, there is an income limit, I would say, to be aware of. So the full deduction is available below the income of $500,000 for joint filers, with the phase out as income increase. So not everyone may receive the full benefits. And important thing is that the higher deduction, or the state and local tax deduction, is scheduled to sunset after 2029. So the deduction will go back to the $10,000 in 2030 unless like Congress extended it. So this may create a multi-year planning window. So one of the takeaway from this, like if you have assumed itemizing no longer applies to you, this may be a good time to revisit that assumption. Another updated provision in the new tax law is the child tax credit. This the credit has been increased to $2,200 for qualifying child, which may provide an additional tax relief for eligible families. The amount is set through 2028, and after that is scheduled to revert to an inflation index amount, like starting at 2000, unless this is extended. So this is, I would say, this is still subject to income phase out, as we said before. So it's like it depends on the income. So for a single filer, the phase out began to phase out around $200,000. For married filing jointly to at $400,000. So this may be like more impactful for some families than others. But the broader planning takeaway is that family with children, they can like still using this, and it's worth visiting it for broader planning strategies. Now we'll talk about the new tax provisions. One important change in the new tax law for retirees is the enhanced senior deduction. So from 2025 to 2028, like taxpayer age 65 and older may qualify for additional $6,000 deduction per person. So that would be $6,000 for single filer or $12,000 for married couple where both spouses are over the age of 65. So an important thing is that this is in addition to the existing standard deduction. So if they are taking the standard deduction, on top of that, they're going to be like the enhanced senior deduction. And that may significantly increase the amount of income excluded from federal taxation, which can affect retirement income planning, including Social Security taxes, IRA withdrawal, like even Roth conversion opportunities. So there is also a limit of income to be aware of. So the deduction begins to phase out above 75 for single filers, $75,000 for single filers, and $150,000 for married filing jointly. But like in general, many retirees may have opportunity to use this deduction. Another headline grabbing addition in the new tax law is the introduction of the what we call it, or being called, the Trump accounts. So for eligible children born between 2025 and 2028, the federal government provide $1,000 deposit at birth into one of these accounts. So parent may also contribute up to $5,000 per year after tax, which like creating another potential saving vehicle for family. And what makes these accounts unique is their flexibility. So beginning at age 18, fund may be used for things like education, job training, or first home. And after age 30, the fund may generally be used for any purpose. So for some family, this may represent another way to give children a financial head start. However, one important limitation to be aware of that these accounts have restricted investment options. So they may be invested in low cost, diversified index fund, such as those tracking the S&P 500. And the expenses should be, or cannot, I would say, cannot be exceeding 0.1%. And that's going to exclude all current Islamic funds that I am aware of. Another new provision in the new tax law is the charitable deduction. It's now, even for those do not itemize deduction, they can take that deduction. So, like in the past, charitable giving often provide the most tax benefit for those who itemize, and this has changed that, right? Because even if you taking the standard deduction, you still can take a charitable deduction. So under the new law, the single filer may deduct up to $1,000 in a qualified cash charitable contribution. And for married couple filing jointly may deduct up to $2,000. And this is applies to cash gifts to a qualified charity, the 501(c)(3) charities. One important thing is that it does not apply to donations of property, stocks, or donor advised fund contribution. So this is specifically for cash gifts. So for many households taking the standard deduction, this may create a simple but meaningful opportunity to receive some tax benefit for charitable giving. Another new provision in the new tax law, for those who itemize charitable deduction. So beginning in 2026, this year, the charitable contribution generally must exceed 0.5% of adjusted gross income before they become deductible. So in other words, this is there is now a threshold or a floor, and that must be cleared before a contribution may generate a deduction. So for example, if your adjusted gross income is $500,000, the 0.5% would be $2,500. So contribution would generally need to exceed that amount before a deduction begins. So that is an important change, particularly for those making regular charitable gifts. So also, I just want to mention that at the same time, the law permanently preserved the 60% AGI limit for contribution to public charity, which remain favorable for larger charitable giving. So for some household, it may make sense for more intentionally about the timing and grouping gifts, including strategies like bunching contribution or coordinating giving over multiple years. So before we move into specific strategies, I want to briefly touch on retirement plan rules, because many planning opportunities start with understanding the rules around the accounts you may already have. So contribution limits change, catch-up provision change, and recent legislation has introduced a new planning consideration. So in this section, we will walk through some of the key rules that may create opportunities around maximizing contributions, evaluating Roth strategies, and making the most of available tax advantages. Now I'll start with retirement plan contribution limits. So for employer-sponsored plan like 401k, 403b, and similar plans, The employee contribution limit is $24,500 with additional catch-up contribution of $8,000 available for those age 50 and older. And there is an important added opportunity for those in the early 60s. So under the Secure Act 2.0, individual ages 60 to 63 may continue to qualify for the enhanced, what we call it, the super catch-up contribution of $11,250 and allowing even higher saving during those final working years. So that enhanced catch-up is only available during the 4-year window. There is also an important rule change beginning in 2026 for individual earning more than $150,000 in W-2 wages from the same employer. Catch-up contribution in employer-sponsored plan generally must be made on a Roth basis rather than pre-tax. So it's only for the catch-up contribution, and that may create new planning conversation around like current versus future tax treatment. For business owners, for example, or those using large retirement strategy, planning may expand even further. So when combined with the employer contribution, the total annual contribution in many plan may reach $72,000. And for defined benefit plan, the limit is increased to $290,000 in 2026, up from to $180,000 in 2025. So the key takeaway is that contribution opportunity may be broader than many people realized, and understanding these limits may create meaningful opportunities to improve both tax planning and long-term retirement saving. So alongside with workplace plans, IRA limits are also worth reviewing. So for traditional and Roth IRAs, the contribution limit is $7,500 in 2026 with additional $1,100 catch-up contribution for those age 50 and older. So of course, eligibility may depend on income, and that's often where planning comes in. So for some household, direct Roth contribution may be available. For other like strategies such as backdoor Roth contribution may worth evaluating. And also it's important to remember that Roth conversions themselves do not have an income limit, which part of why they can become like an important planning tool. So whether we are talking about workplace plans, IRAs, or conversion strategy, the broader theme is the same, like making sure you are using the full range of tax advantage saving opportunities available for you.
Thank you for that, Reem. That was very insightful. Always a lot of changes going on with the tax code from year to year. So it's always great to stay up to date because sometimes it presents new opportunities, sometimes challenges that need to be addressed. So thank you for that, Reem. So now that we've covered the tax changes and the conceptual background around tax planning, let's move from theory into practice and apply this to more of a real world context. So we'd like to address how we would approach tax planning from 4 common household profiles that we typically work with. Each of these profiles have very different financial situations, income levels, and tax challenges. And while tax preparation treats them somewhat similarly, just reporting income and capturing deductions, tax planning looks very different for each one. So what I'd like to do is we're going to walk through each of these profiles one by one and have Reem tell us about how she would approach these profiles from a tax planning standpoint, with the tax considerations for these groups of folks. So profile one is what we call the growing household. These are folks who are in their late 20s, maybe late 30s. Often they have young children. This can be one of the most expensive stages of life. Uh, these folks are building their career while also navigating new expenses like childcare, daycare, early education, and all of the financial demands that come with raising a family. So at this stage, really like the focus is often trying to balance your cash flow needs on a day-to-day basis with the early steps of long-term wealth building. And that's where tax planning can really begin, setting the stage for decisions that allow for tax efficiency in the future. So, Reem, could you tell us a little bit about how you would approach tax planning for this group of folks?
Yes, sure. As you said, like we emphasize on the cash flow. So the starting point is understanding your cash flow, specifically whether there is a capacity to save after covering the monthly expenses. So once that's established, the conversation often shift to goal setting. So how do you balance building an emergency fund, saving for retirement, and managing short-term priorities all at the same time? So this is where planning can help bring structure. So we often look at whether you are taking the full advantage of your employer-sponsored benefits, such as flexible saving account, the FSAs, dependent care accounts, and retirement plan, all of which may provide meaningful tax advantages. So sometimes tax planning starts simply by making sure you are fully using the benefits already available for you. Um, so with as you mentioned with young children in this like for this group of people like with young children education planning often become a priority, right? Like many family ask, should be using a 529 plans, or should we consider like custodial accounts such as AGMA accounts, or should we evaluate the new strategy for dependents like Trump accounts? So these are like several like vehicle, I would say, in each with different tax implications, level of control, and long-term consideration. And also, if we want to take in consideration the halal options, like for example, the 529, there's no halal options on them. Like for Trump account, as we discussed before, with the fees that should be like 0.1% and following an index and all of that. So probably the halal option is not um, available for these. So all of these things like we can discuss with them. So the goal is not simply save for children, but to do so in a way that is flexible and tax efficient and follow the halal rules.
Right. Yeah, so like a lot of times people might think that this stage is relatively straightforward from a tax preparation perspective. But there's really meaningful planning opportunities often below the surface. Many of the decisions, this is where you're really setting the early steps, and you want to consider these goals that you have for the future and the tax efficiency of reaching those goals. So really starting off on the right foot by utilizing tax advantaged accounts wherever possible is really we place a big emphasis on that for this group of folks. Um,
Yeah, so as you said, like it's like from uh, tax preparation, it seems like probably straightforward with W-2 and some deduction, but we can like look into opportunities like whether they should like take the standard deduction or itemizing, for example, right? Is they are they using all the retirement planning options, right? Like, is there a way that they can utilize any way to reduce their taxes, right? So these are the strategies that we work with this group of people on in order to help them with their taxes.
Certainly, yeah. Thank you, Rim. So moving on to the next profile here. Now we're going to shift into a different stage of life. Um, if this sounds like you, income may have. This is a group we call high income earners with business income. So business income is part of the picture, and financial decisions for these groups of folks feel a lot more complex than they probably used to be. These folks may have children that are older in middle school, maybe approaching college and or high school. And the financial structure at this stage of life gets more sophisticated. At this stage, one of the largest expenses for these folks isn't necessarily lifestyle, because now they have a high income, but really it's taxes. They're in a completely new higher tax bracket. And so that's often where tax planning starts to take a slightly different role, not just helping you save, but helping you think more strategically about how that income is structured and how those taxes can be managed over time. So Reem, could you tell us a little bit about each of these like major considerations for these folks when it comes to tax planning?
Yeah, sure. So with this group of people, like the conversation often start with the business. So the focus is going to be the business. And one common question may be, when does it make sense to consider an S corp, for example? At a higher level, I'm not going to the details or anything, and this is may come down to how the income is structured, balancing salary and distribution in a way improve efficiency. So beyond that, we look at the overall entity structure and making sure all available deduction are being captured, and explore opportunities such as employing family members, not just for only like an income strategy, but potentially it's a way to begin building to begin build savings for the children early on. The qualified business income, also what we call it the QPI deduction, may be an important part of the discussion. The qualified business income deduction now is 20%, and it's permanent. So it may represent a meaningful planning opportunity for many business owners. So the goal here is to help make sure the business is working as efficiently as possible for both income and tax perspective. In terms of retirement strategy, this is often where planning opportunity expand for this group, because as a business owner, you may have access to significantly higher contribution opportunity than a traditional W-2 employees. And that can create like important decision around strategies like SIP IRA, solo 401ks, or even like 401k, and including how to determine the right fit and how to maximize contribution. So this is also maybe where we discuss strategies like backdoor Roth contribution, since they cannot do like direct Roth contribution, or using the health saving account as a long term tax advantage saving vehicle. Coordinating retirement planning across both spouses can be another important layer. So the overreaching goal is often to shift as much wealth as possible into efficient accounts over time. And in terms of credit and giving and saving, at a higher level of income, some traditional tax credit may phase out. So, uh, but this is not necessarily mean planning opportunities disappear. So maybe it's sometimes we think about it that the focus is kind of shift. So this may include looking at whether to itemize deduction, incorporating charitable strategy with the itemizing, such as donor advised fund, and continuing to plan for education and even legacy goals for the family. So we also should stay focused on how evolving the tax law may affect the situation over time, where those changes may create planning opportunities.
Yeah, certainly. It can be easy to assume that like once your income reaches a certain level, opportunities diminish because there's not as many deductions. I'm sorry, not as many of the lower income credits and deductions available. But in reality, the opposite is true. As income and complexity increase, so can the impact of thoughtful planning. And these folks with the business, they have a lot at their disposal in terms of, qualified plans and in terms of writing things off. And so, yeah, the business is really a focal point of the discussion for these folks. Um, Often, it's not just about taking one major move, but a series of small adjustments that really add up over time. And that's why proactive and strategic decision making can be especially valuable at this stage. So now moving on into the next stage of life, the almost retiree stage or the pre-retiree stage. If this sounds like anyone in the audience, you may be in the final stretch after decades of saving, accumulating, and building wealth. You're approaching the point where you're preparing to begin relying on those assets. And this is where the mindset often shifts because your focus at this point is no longer simply on accumulation, but planning a map for how you're going to begin distributing these assets in the most tax efficient way. At this stage, planning often becomes about coordinating your income decisions before retirement begins so that you do have a strategy in place once you move into retirement and start drawing from what you've built. So this is a group we work with a lot here at Azad. Reem, could you tell us a little bit about this group's tax planning considerations?
Yeah, so as you mentioned, Tamim, the income is the key here. So at this stage, one of the most common concern is how to generate cash flow in retirement without creating unnecessary tax burden. So a major risk can be often referred to as a tax torpedo, where like income sources from Social Security, required minimum distribution, and potentially Medicare surcharges began to overlap and push income higher than expected. So this is why like forward planning can be so important. So many people have a window of time before Social Security begins and before the RMDs are required. So when they may temporarily fall into lower tax bracket, that can create a planning opportunity. So during this period, we may evaluate Roth conversion strategies, shifting assets from pre-tax account into Roth accounts at potentially lower rates, which can help reduce like RMDs, like the future RMDs, and smooth income over time. So the goal is not simply generate income, like generate retirement income, but doing it so thoughtfully and efficiently. And in terms of charitable giving, many people in this stage, and this is how we see it, like they are thinking more intentionally about giving. So there may be several ways to do that efficiently at this stage, and this could include strategies like donor advised fund, bunching charitable contributions to maximize deduction, qualified charitable distribution once eligible. So the current law may also create charitable deduction opportunity even for those who do not itemize, as we mentioned before. So the goal is to align the charitable intent with the tax efficiency. So giving decisions support both the value and your broader planning strategies. In terms of deductions and tax consideration, so I would like to mention like deduction. We mentioned before the enhanced senior deduction, right? So there can be a confusion around Social Security taxation. There's like a couple of messaging or something saying that Social Security now is not taxed, but the underlying taxation rule for Social Security remain the same. So what have changed is these deductions. So the enhanced deduction for individuals 65 and older, combined with the standard deduction, as we mentioned before, may reduce your taxable income and potentially affect how much Social Security is subject to taxes, but does not mean that the Social Security is not taxed now. And beyond that, we look at several key areas, include standard versus itemized, capital gains and tax loss harvesting opportunities, looking into IRMA planning, since if you have like higher income, it may lead to an increased Medicare premiums. So these are like often kinds of decision that benefits from planning before retirement that reaching after fact.
Right. So really, with these folks, it's a very crucial stage of life for tax planning. Um, it really, you're like at that stage where it's before retirement, and you're just about to approach this, which for most people is a temporary phase of life where the tax rates are low before that tax torpedo kicks in. And so you really want to have a strategic plan in place before all these moving parts come in. So really, like a lot of things, planning decisions around Social Security, withdrawals, Roth conversions, charitable strategies, all of these things need to connect into a cohesive strategy that's ultimately going to serve you for the next stage of life that comes along. Okay, so thank you, Reem. Let's move on here. So profile 4. So these are the folks that are, as you can see from the slide, already in retirement. So at this point, you're no longer preparing for retirement, you're actively living in it. So income might be coming to you from Social Security, from required minimum distributions in your IRAs, or your investment portfolio. And while some themes do carry over from the almost retiree stage, the key difference now is that the decisions are no longer theoretical for the future, but they're happening in real time. Ideally, we're executing the plan that we had put together pre-retiree stage. So the focus at this stage is less about preparing for future income decisions and more about managing the income that you're taking today as efficiently as possible. Reem, can you tell us a little bit about tax strategy for these folks?
Yeah, so this group of people, they are in retirement, as you mentioned, and at this stage, we want to manage the income thoughtfully and tax efficiently. So again, like while the underlying rule around Social Security taxation, as we discussed before, remain the same, the enhanced deduction for individual age 65 and older on top of the standard deduction may create meaningful planning opportunities at this time. So with proper coordination, this deduction may help reduce taxable income in some cases and affect how the Social Security is subject to tax. So that's why like income tax planning can be most important, because even small adjustment may improve tax efficiency in retirement. And at the same time, we may be actively managing the timing and the tax impact of required minimum distributions, withdrawal strategies across taxable, tax deferred, and Roth accounts, ongoing growth conversion opportunities, even during retirement. And again, for this group, IRMA threshold, since the income level can directly affect the Medicare premium. So the goal is to help to make sure these moving pieces work together, that rather than unintentionally working against one another. In terms of charitable and estate planning at this stage, so charitable giving often becomes a greater priority at this stage. And one of the most effective tools may be to do the qualified charitable contribution, or QCDs, because QCDs are made directly from IRAs. They may reduce the adjusted gross income and help multiple tax related threshold at once. Like we can help manage this and reduce your tax bracket. We may also incorporate strategies such as donor advised funds also, and a broader state and legacy planning. Another important and sometimes difficult conversation may be planning for a loss of a spouse. So a shift from married filing jointly to single filing status. While the income stay relatively high, it can significantly increase the tax exposure for surviving spouses. So, and that is like why proactive planning in this area can be so important. In terms of deduction and tax consideration, so from a broader perspective, we may review several areas each year, and that may include whether the standard or itemized deduction makes sense, opportunities such as like capital gains and tax loss harvesting, how the new law may affect retirement income, for example, and how Medicare-related threshold may impact overall planning. Long-term care consideration may also be part of that conversation. So at this stage, like planning is often ongoing coordination, not one-time decision.
Yeah. What's clear here is like the retirement planning doesn't stop once you retire in a lot of ways. And that's where coordination becomes even more important. There are, even the smaller decisions around withdrawals, taxes, Medicare, charitable giving can have immediate consequences because all of these pieces are connected in your financial life. Um, and really, at the stage, the objective is not just simply preserving assets, but making sure those assets support you effectively and ultimately uh, transfer as efficiently and intentionally as possible. So thank you, Reem. Now, I want to take some time to go over some frequently asked questions when it comes to tax planning. So give me just a moment here. I'm gonna get them pulled up. All right. So this is a question we get a lot for people approaching retirement and retirees. So does your Medicare income-related monthly adjustment amount go down if you have less income in future years?
Yes, so you're referring to the IRMA, which is the income-related monthly adjustment amount. So that can be changed from year to year based on your income. That's correct. So because Medicare generally uses your tax return from 2 years prior to determine the IRMA. So a decrease in income may eventually result in a lower IRMA surcharges in the future. So for example, when we talk with a client about Roth conversions, so if we are going to do the Roth conversion this year in 2026, it may affect their 2028 in 2028 when they prepare their taxes, the effects will maybe show in 2028 because they look back 2 years, right? They look back into 2026 to determine that rate. So we have to be like thoughtful to that when doing Roth conversion. And so to answer this question is yes, it can affect or can change it each year.
Right. Okay. Thank you. And so moving on to this next question we have here. Oh, this is a good one. Okay, so can you make a Roth conversion from an inherited IRA? So with inherited IRAs, generally those have to be put into a beneficiary IRA and withdrawn within 10 years. Reem, could you tell us, is that something that is allowed?
Yeah, no, you cannot do Roth conversion from an inherited IRA. So the IRS specifically prohibits any rollovers, including Roth conversions from an inherited IRAs.
Right. So there, you're going to have to rely on other ways to tax plan around those 10 years of distribution. Um, so how do you compare how do you compare donating appreciated assets versus using QCDs for someone with no required minimum distributions? So those are the withdrawals that they force out of IRAs when you reach a specific age.
Yeah. So I would say it depends, and the optimal approach depends on the client's lifetime, like giving the giving horizon, their assets. So donating appreciated security generally maximize current tax efficiency, while QCD maximize future tax control by shrinking the pre-tax bucket. So um, we need like the complete model like and projections to in order to decide if it's better this or the other one. So I would say it depends on the case by case.
Right. It's hard to apply a general rule of thumb because everyone has so many different
Mhm.
income sources and different things going on in their life.
Yeah,
Uh,
and this is why like tax planning is very important, to talk to your advisor about tax planning and coordinate with your CPA in order to make sure that you're doing the right thing. So it's sometimes won't affect only 1 year. It's, as you said before, it's ongoing process, right? And forward thinking.
yeah, certainly. So it's so important to like inform that by crunching the numbers and seeing, okay, what is really going to get us the best position overall. So another question we have here, I had a lot in capital gains with some very highly appreciated stock. What can I do to plan for when I eventually sell this?
Yeah, so there are several strategies can help manage or reduce the tax impact for capital gains. One of them, the tax loss harvesting, so offsetting gain by realizing losses in other investments. Maybe another strategy, use the donating the appreciated securities may help avoid capital gains taxes while supporting a charitable goals, right? Review your tax bracket, like coordinate gains with lower income years when possible, of course.
Yeah, and those are, recommendations we make a lot when we meet with clients for financial planning, and then deciding which of these um, apply or when you should do each of these, when should you harvest losses, when should you donate. It really depends on your situation, and that's another thing that we can model and time those decisions as well. All right. I'm retired and I received an underpayment penalty. How can I prevent that?
Yeah, so in order to avoid that scenario, so if you're taking a distribution from your IRA, for example, you can withhold taxes when you take that. So it can be an effective tool because you withhold the taxes. It's not like you're taking the whole gross amount and then you pay the taxes. So you pay the taxes in front before you take the money from your IRA. And you can review your income sources annually, for example, like Social Security, pensions, RMDs, investment income, to adjust that. And also, you can use the IRS safe harbor rules, like, for example, paying 100% or 110% of prior year taxes, and it depending on your income to help avoid the penalties.
Let me ask you a question about that, Reem. When it comes to safe harbor, so if somebody is in their first year of retirement, I'm sure the prior year they had a much higher income than they do that year. Are they still required to withhold that safe harbor amount?
So it is in two ways you can think about it. So if you withhold more than what you need, so you're gonna get a refund afterward, right? But the way to think about it, maybe as we said, like you review your income sources. So if you still have income from previous year, if this year you don't have income, so it's different. So you can plan it and see how much you would owe taxes and then you pay it, but you can pay more and then you receive the refund afterward. But maybe it's not like what you want to do, right? Like to withhold your taxes. Maybe you can invest it, like not withhold it with the IRS, right? So it depends on the decision, and you can discuss that more with your CPAs if uh, the income ranges is changed a lot.
Certainly. Thank you so much for your time, Reem, and um, just want to thank everyone who joined us live today. We really appreciate you taking the time to be here. If you're looking for more information or have any questions about our services, please don't hesitate to reach out to us at hello@izzadasset.com. Likewise, you can go to izzadasset.com under the Connect button and schedule an introductory consultation with a member of our team. Before you go, we'd really appreciate it if you could take a quick survey that's going to pop up here after the webinar ends. Your feedback really helps us improve, and it only takes a minute. Thanks again, everyone, for your time today. Jazakallah khair, and we hope to hear from you soon, inshallah. Assalamu alaikum.